Standard corporate accounting relies on a single governing assumption. The entity exists to generate a profit. You inject capital and raw materials into the system outputs goods and services, which are sold to generate revenue, dividends, and a calculable return on investment. Sovereign states and public sector entities operate in a completely distinct economic environment. Their primary inputs do not come from voluntary investors. They are acquired through taxation and mandatory wealth transfers. Their outputs are public goods and services, infrastructure, defense, public education, distributed broadly across a population. This split-screen flowchart maps the discrepancy. The corporate model on the left forms a neat closed loop. On the right, the public sector is linear. The financial value extracted does not equal the specific service received. The return loop is broken. To accurately capture this structure, the International Public Sector Accounting Standards Board, the IPSAS, developed a specialized conceptual framework. This framework confronts the core paradox of public accounting, measuring financial performance for an entity that theoretically exists forever, generates no profit, and is funded by mandatory wealth extraction. Applying a reporting system built for corporate profit maximization to a sovereign state produces mathematically irrelevant data. Therefore, an entirely new architecture is required. In accounting theory, reporting frameworks are reverse-engineered from the specific needs of their end users. A corporate balance sheet is designed to answer the demands of shareholders and investors calculating their financial returns. The users of public sector financial data have entirely different objectives. This stakeholder map identifies the primary users, service recipients, citizens relying on the government for necessary public goods. The second group is resource providers, taxpayers, lenders, and donors. Because populations are vast, legislative bodies act as central proxies, analyzing data for both groups. A strict constraint binds these groups. Unlike a corporate board, an individual citizen or taxpayer lacks the legal authority to demand a customized special-purpose financial report from their government. To solve this, the IPSAS framework establishes the General Purpose Financial Report, or GPFR. This is a standardized document engineered specifically for users who cannot demand tailored data. Because citizens lack the power to audit the state on demand, the GPFR acts as the single universal vehicle for enforcing democratic accountability over public funds. Private companies fund their operations through voluntary sales. Governments fund their operations primarily through legal mandates. In the IPSAS framework, this mechanism is defined as a non-exchange transaction. This visualization shows taxation as a non-exchange event. A taxpayer contributes $10,000 to a central government node. In return, they receive non-quantifiable benefits, like national defense, with no direct correlation to the amount paid. Multilateral donor funds similarly enter without equivalent financial return. Because the revenue is involuntary and the output is asymmetrical, traditional return on equity calculations fail. The public sector GPFR replaces wealth measurement with a new primary objective, discharging accountability. In a sovereign context, accountability means proving absolute compliance with the legal mandates and budgetary limits approved by the legislature. It also requires proving that the resources extracted were used efficiently and effectively to deliver the intended public services. By extracting wealth involuntarily, the state absorbs the burden of proof. The focus of the financial report shifts from measuring profit generation to proving accountable stewardship of public resources. Corporations have relatively short lifespans, often measured in decades. Sovereign nations, however, operate on a virtually infinite time horizon, outlasting generations. A standard, static balance sheet cannot capture the reality of long-term sovereign obligations, like multi-generational social security programs. To accurately reflect the state's true position, the scope of the GPFR must expand far beyond traditional financial statements. The baseline GPFR relies on traditional financial statements. To this, we add approved budgets, testing legal spending authority. Next, service delivery achievements use non-financial metrics to verify outcomes. Finally, prospective information applies forward-looking models, recognizing current decisions dictate the financial burden on future generations. A public sector entity's true financial health can only be determined when historical spending is combined with future commitments and verified service outcomes. Expanding the scope of the GPFR introduces a severe risk of information overload and data obscurity. To maintain utility, The data is filtered through qualitative characteristics. First, faithful representation. Second is neutrality. And finally, prudence. We see faithful representation tested most rigorously by the unique challenge of specialized public assets. Many government assets have no market equivalent. You cannot find a commercial market price for a military defense system, national park, or heritage monument. The framework defines their value through service potential. These assets are held strictly for their capacity to deliver public services, not to generate cash flows. When projecting the value of these assets or the cost of future programs, the framework demands prudence. Calculating long-term social liabilities involves extreme uncertainty. Neutrality requires absolute caution when projecting decades of future commitments. Prudence enforces a strict dual mandate: ensure current assets are not overstated, and guarantee future liabilities are never understated. Rigorously applying these qualitative filters prevents governments from artificially inflating the value of non-market assets or concealing the true weight of their future social obligations. This flowchart represents the completed architectural blueprint of the IPSAS conceptual framework. We trace the logic from the underlying axioms of sovereign non-exchange revenue down to the constraints of the citizens and taxpayers. Those specific user needs force the expansion of the reporting scope beyond the balance sheet. That data passes through strict qualitative filters, resulting in the finalized GPFR. This is a ground-up redesign optimized for sovereignty, not merely a modification of corporate rules. A compliant report must seamlessly merge retrospective financial data with prospective sustainability and verified non-financial metrics. When compiled with this rigor, general-purpose financial reports serve as the financial bedrock of democratic accountability. They ensure the involuntary extraction of taxes remains transparent, measurable, and entirely justifiable to the public.